Good afternoon. David Edwards, Heron Wealth in New York City. It's a gorgeous summer day here in New York State where we are currently living. And looking forward to talking about tonight's topic. A little bit different than last month. Last month we went into a deep dive on technical indicators like to follow. This month we're going to talk a little bit more about why those technical indicators matter. And I was thinking about an experience that many of us have had over the years. At the end of a long plane flight, you're coming into JFK or LaGuardia or Newark or Logan or Los Angeles or Chicago, and the pilot comes on and says, "Hey folks, we're gonna have a little bit of turbulence. There's a thunderstorm ahead of us, but don't worry, we'll get you on the ground before you know it." And before you know it, the whole plane is rocking and rolling and yawing, and it's pitch black outside, and the plane drops 200 feet at a pop, and the passengers get a little concerned and upset. And they put down their videos and drop their vodka and think about texting their families because they think they might die. And the last 6 months was kind of like that thunderstorm, and it seems like we got into some smooth sailing, but now I see some more thunder ahead, speaking as your pilot. So I'm going to run a little video that we put together, and it's going to show two things: what the passenger sees and then what the pilot sees. And then after the video is over, we'll talk about what's the meaning of all this. So this is the thunderstorm starting up. This is the passenger looking out the window. And now this is what the pilot sees. Not much more than the passengers can see. So this is where the passengers wonder, are they 1,000 feet up or 100 feet up? What's coming up in the distance there? And there we go. A perfect landing. So, why did I put this video up? Well, for 99.9% of the time, the pilot of your plane runs the plane on autopilot. The pilot and the co-pilot sit up front, keeping an eye on the instruments, occasionally talking to the passengers, but they really don't have much to do. And it's the same thing with being a wealth advisor. Sure, when our clients have some questions or problems or want to have their financial plan reviewed, yeah, we're there. But as far as their investment's concerned, 99.9% of the time, it's on autopilot as well. Every once in a while, we have to turn off the autopilot and jump on the controls and work actively to make sure that plane gets to the ground. So how do we do that? Well, the pilot has a couple of things to helping them out. This is the cockpit of a 737 MAX. It's a pretty modern plane, and it's all fly-by-wire. All of those screens are computer screens. But getting back to the basics of aviation, the pilot relies on a handful of instruments. Airspeed, how fast are we going? Altitude, how high are we? Rate of climb or descent. If the plane is level, that means one thing. If the plane is rising, that means something else. If the plane is descending, that means something else. Very important to keep an eye on that. Heading, which direction are we going to? Bearing. Bearing is different from heading. Bearing is the direction to where we want to be. If the heading and the bearing are lined up, we're on the right route. If the heading and the bearing diverge, we have to make some corrections. Lastly, fuel level, so important. Running out of fuel in your car, not a problem. Running out of fuel in your plane, big problem. And the whole point of all these instruments is to get you to the point of connecting to the ILS system of the airport, the instrument landing system, which is a system of radio waves and transmitters that talk to the plane and help the pilot line up the last last mile or so, even if they can't see more than 100 yards in front of the plane. And that's what we saw in that video was the plane on ILS guiding down to a perfect landing. So what does our cockpit look like? last month, we went through about 40 charts, all the things that I look at. And there was an awful lot of detail there. And it occurred to me that I had to bring out this picture that we've used on numerous occasions in the past. We call this the red light, green light macro model. And there are different components of the economy and politics and society that feed ultimately into stock market values. And sometimes they're green, sometimes they're yellow, sometimes they're red. So just skimming at a high level, right now currencies are neutral. The dollar is falling against major currencies, but that doesn't seem to have too much impact on the stock market or the Federal Reserve policy right now. Economic reports, universally in the red right now. Jobs data, we've lost more jobs in the last 5 years than we gained in the previous 8 years. It's pretty awful. Industrial output down sharply, housing kind of staggering a little bit. What's supporting the housing market right now is low interest rates, but as people continue to not go to work, how much longer can that last? All of that feeds into what we call inflationary expectations. The Fed is more willing to lend money, lower interest rates when inflation is not an issue, and then they will raise rates and constrict the money supply when inflation is expected. Well, right now, the Fed expects no inflation. So the Fed has driven money markets and bond prices to the lowest levels of the last 40 years. So the Federal Reserve policy right now very supportive of the stock market. The bad news is that the Federal Reserve has no more arrows left in the quiver. When rates are zero, you can't go to less than zero. Commodities prices, less important now than they were a decade or 2 decades ago. But generally speaking, rising commodity prices was a forecast of inflation and also rising industrial demand. And right now, commodities are about slammed as hard as they can get. The only commodity that's doing well is gold. We'll talk about that a little bit more later. Technical factors. We talked about this last month. Although there are 500 stocks in the S&P 500 and 3,000 stocks in the Russell 3000, the Russell 3000 includes about 99% of the US stock market, really only 10 stocks are performing well. The other 490 S&P stocks or the other 2,990 Russell stocks, they're doing poorly. So technical factors are poor. The bond market is neutral right now. Yes, it's great. The interest rates are at 40, 50-year lows, but they usually can't go much lower. And then the biggest red mark right now is politics. The Congress and the Senate and the White House are unable to extend a new package to support the economy. Well, here's what happens next. Right now, a lot of Americans are relying on an extra $600 a month unemployment check to get by, and that ended last week. A lot of Americans are relying on the federal policy preventing mass evictions, and that ended this last week. Of the 40 million Americans who lost their jobs earlier this year, 5 million lost their health insurance at the same time. And so all these people are desperate for some leadership out of Washington to kind of tide them over until times were better. And that ended on July 31st. So when we see that, we see the mother of all thunderstorms coming up just over the horizon. And we think that August, September, October are going to be pretty awful for the economy. And then eventually that will bleed over into the stock market into what we call the Wile E. Coyote moment. So you remember Wile E. Coyote, as long as he didn't look down, he would stay suspended in the air. Once he looked down, down he went. And the stock market, 40% rally off the low. There's nothing supporting the stock market right now. And I don't know what the trigger will be to drop it 10, 20% in the next 6 months, sometime in the next 6 months, but it's going to happen. And so what we've done to prepare our clients is, first off, we've gone through all our portfolios and looked at any portfolio that was overweight stocks in general and rebalanced them. And if you're a client of ours, you would have gotten a notice about that from Lucas, our portfolio manager. We've also had some pretty frank conversations with our clients. What do you need in terms of money in the next year? Do you got a house closing coming up, a big renovation coming up? You're sending a kid to college? Tell us what those big cash flows are now. we're taking the money out of stocks now. And then there's the obvious question, well, what if we just pull all the money out of the stock market and just wait till this crisis is over? If we could do that, we would do that. Unfortunately, we don't know exactly when the pullback will occur. August, September, October, November. November if the election runs into December, right? And also we don't know the exact moment to get back in again. And then along the way, our clients incur capital gains taxes if we jump in and out of their taxable portfolios. So as long as we have had a very good conversation with our clients about the money they need for the next year, the rest of that money can stay working in the stock market. It might come down, but then it will come back up again, as we saw in March to April, big sell-off in stocks, big rally back, May, June, July, August, and that's how it goes normally. So because it's such a beautiful day, I deliberately kept my remarks on the short side. We did get some questions from our clients, and Rafi Salem will jump in and ask those questions.
Sure, David. By the way, David, do you see that you and I are appearing on the screen as well as to the side of the screen?
I do, but that's because we're the panelists, and it's fine.
Okay, that was the first question. That was the bonus question. So first of all, Nina from New York asked or commented, I found your personal attack on Trump extremely offensive, and it didn't add anything to your analysis. So although your thoughts on the president may or may not be well-founded, it is very unprofessional for a wealth manager to express a personal opinion about someone's character. As a professional, you should only be concerned with how Trump or Biden, if elected, would affect the economy and thus impact a client's portfolio.
Yeah, and that is a comment that came up after last month's webinar. And Nina's a friend of mine, and we had an exchange about that. For sure, I get a lot of criticism about my political analysis. Historically, wealth advisors were never supposed to talk about religion or abortion or politics. But this is an unprecedented time. And the things that are happening today in Washington and in our society in general are moving us in a direction, hopefully still reversible, where we lose our civilization. And I'm a historian, and I saw how the Roman Empire fell. I saw how the Islamic Empire fell. I've seen how the British Empire fell. The American Empire is only 100 years old. It started around 1918 at the end of World War I, and it prevailed up until the last couple of years. At this point, the Chinese economy is now larger than the US economy. We won't know that for sure another 2 or 3 years, but that's the reality of the situation. And then also, there are things about Trump that are uniquely terrible. I used to ask myself, is Trump like Nero fiddling while Rome burns? Is Trump like Captain Queeg on the bridge of the Cane during the typhoon? He froze up, I didn't know what to do. Is Trump like Hitler hiding in the bunker last few weeks of his life? Is Trump like Bashir Assad of Syria, who was a mild-mannered optometrist who ended up being the president of Syria? And in 2011, there were some political protests in a remote province, let's call it Portland. And he sent troops to deal with those unrest, and they grew bigger and bigger and bigger. And the eventual civil war in Syria killed 500,000 people out of 12 million. That's really astonishing for a mild-mannered optometrist, So, so while I would be thrilled to not have to give my opinions, and by the way, my professional opinion is a lot milder than my personal opinion about Trump, I believe that this is one of the turning points in American history. And if Trump is still in office in February 2020, we can just give up and watch all our gains go away. So that is how I feel about Trump. And anybody who feels differently, I encourage you to send me an email, davidedwards@heronwealth.com, explaining why I'm wrong. And I will cheerfully post that in a future commentary.
The main thing is to keep the lines of communication open.
Absolutely. It's not, I don't feel it's personal. I feel that it's my job to see danger where danger occurs and warn. And there was a great quote. Let me see if I can bring it up real quick. It's a famous quote. The only thing necessary for the triumph of evil is for good people to do nothing. And I would hate to be that good person doing nothing 10 years from now.
All right, moving on to the next question coming from Shannon in California. Should we add gold and commodities to our portfolios?
Yeah. So strangely enough, although commodity prices in general are at multi-year lows right now, gold is at a multi-year high. And the reason why commodities in general are at a multi-year low is because demand all around the world is low. Even before this crisis, as the whole world economy, the US first, of course, Europe second, more recently China, have moved away from goods and more towards services. The demand for copper, steel, hemp, wheat, all those kind of basic materials was in decline at the very same time that producers were becoming ever more efficient at producing it. Energy prices, for example, we have record energy use on this planet right now, but oil was in a slow, gradual decline before the crisis started, utterly collapsed in March, was negative for a while. People would pay you to take oil away. Now it's back in the 30s. A couple of years ago, I thought oil would be around 100 in a full-blown economy. It's not there at all. Gold is a little bit different. Gold has a strange psychological component. In a crisis, people feel like if they have a couple bars of gold in their basement, it will protect them from looters or malfeasance or whatever. And I just tell my clients, you can take that gold bar and bash in your neighbor's head and steal their food. That's the utility of gold in a true crisis. We used to have about a 5% exposure to commodities in our portfolios. We just removed it a couple of years ago. It just was 0.0 for a decade, and it hasn't gotten any better. So gold, Shannon and I will talk about this separately when we next talk, but I'm not adding to my client portfolios right now.
All right. Next, moving to Bruce from New Jersey. I'd like to have a call to discuss rebalancing. I'm thinking more dividend-paying stocks in the mix will help with return over the next few years.
Right. So that is a classic risk reduction strategy. If you want to have exposure to the stock market, but you'd rather not be in high-flying tech stocks or high-flying pharmaceuticals, whatever, you'd buy boring utility stocks with dividends, or boring telecom stocks with dividends, or boring bank stocks with dividends. Well, here's the problem I have right now buying dividend stocks. I have no idea which of these companies are gonna have a big dividend cut. BP, for example, British Petroleum, in February announced that they were increasing their dividend and moving towards green energy, which is admirable. But in their earnings report last week, announced they were cutting their dividend in half, and they're still moving towards a green energy strategy, but it's just gonna be longer before they get there. So if you're classic dividend stocks are REITs, real estate investment trusts. Well, what if real estate collapses? Right, Midtown New York is a ghost town right now. What about petroleum pipelines or gas pipelines, energy producers? They don't care about energy prices. They just get paid for volume. Well, volume is way down, and it may stay down for a long time. So I can't buy dividend stocks willy-nilly without doing a deep dive on whether those dividends are sustainable, and I won't really know until next year.
All right. Jerry from Idaho. Just saw Paul Krugman's latest column, and it sounds pretty scary. Just to remind you, we talked about this. Krugman's conclusion was the 2008 financial crisis and the sluggish recovery that followed weren't that long ago, and they taught us valuable lessons directly related and relevant to our current economic plight. Above all, experience in that slump demonstrated both that economic depressions are no time to obsess over debt, and that slashing spending in the face of mass unemployment is a terrible mistake.
Yeah.
But nobody in the White House or on the GOP side of the Capitol Hill seems to have learned anything from that experience. In fact, not having learned anything from the last crisis almost seems to be a requirement for Republican economic advisors. So, at the moment, we seem to be headed for a greater recession. a worse slump than 2007, 2009, overlaid on the coronavirus slump.
Yeah, yeah. This is very serious. This is the thunderstorm that I'm most focused on. Even back in the 30s, when Roosevelt first became president, the country was in shock from the Great Depression, and Roosevelt ran up all these new programs to spend money, blew up the deficit at crazy levels, and got the economy heading back on the right track for recovery. But then there was a change in Congress. Some more conservative people came in. A lot of those programs were shot down or found to be unconstitutional. And then the country slid back into recession in the second half of the 30s and stayed there until the stimulus of World War II came along, which was a case of massive deficit spending. We saw after 2008, 2009, initially there was a burst of spending around shovel-ready infrastructure projects. Oh my God, I'd love to see some bridges and tunnels built around here. But then when Congress changed again, all of a sudden austerity became the watchword. We can't spend more than we bring in. And as a result, the recovery from the 2009 crisis was the slowest and most grudging recovery of any economic recession or depression in the last 100 years. So just when we were almost at liftoff state, and by the way, the most critical measure of how the economy is doing is the percentage of adults that are employed. That number peaked in 2000, got pretty low by 2016, was on the recovery the last couple of years, and then has since just fallen like a rock. And the unemployment numbers that have come out say that unemployment is currently around 10%. I don't believe those numbers at all. There's 10% of people that are looking for jobs, another 5 or 10% that have given up looking for a job and are just staying home. And as a result, that's why the employment numbers look better, but they're not. So here we are now. We've had 3 stimulus packages so far this year. The Democrats had a 4th stimulus package good to go 2 months ago. The Republicans kind of went on vacation for July, kind of came back the last few weeks. Now the Senate Republicans can't agree on what's allowed and what's not allowed. And so maybe nothing happens. And the dialogue that I don't get is that, oh, if we give people $600 a month, they won't look for jobs. And does anybody know what $600 buys? $600 buys food for a family of 4 for 1 week. It doesn't pay your mortgage. It doesn't pay your health insurance. It doesn't pay your car loan. It doesn't pay your gasoline bill. All right. So what we're saying right now to, I don't know, 25 million Americans, hey, you can just starve because we are afraid of deficits here in Washington. And, I've seen bread lines at churches around here. I'm in a kind of a rural, fairly nice part of New York State, and I've seen bread lines already. And what's going to happen, 2 months from now, 3 months from now, when people who've lost their jobs and lost their health insurances also get evicted from their homes and have no money for food? What happens then?
So 3 more questions came in.
Great.
And we've got 5 minutes left if you want to end at 6:30. The Warren Buffett indicator of market cap to GDP is even higher than the 2000 bubble at 170%. I'm surprised you feel the market will only drop 10 to 20% and come right back. It should fall 60% or more.
Yep. So those technical indicators on that we look at, well, we've got the Warren Buffett indicator, we've got the Schiller indicator, we've got a bunch of our own, and they all show the stock market overvalued. Not as bad as 2000, but definitely on the high value side. And the reason why is because earnings are evaporating and revenues are evaporating. What will keep the stock market from going down 50, 60% is the fact that interest rates are so low. And if you have money to invest, the stock market is the only place that seems to have a positive return right now. Bonds are so low, corporate bonds are so low, international markets aren't so great. But even then, it's all flowing into those 10 companies we talked about last month: Facebook, Amazon, Google, Netflix, Apple, and that is not healthy. Oh, Tesla, yeah, through the roof. So 10%, 20%, that seems reasonable. The other thing is, when we had that big washout in April, a lot of the weak hands in the market got taken out, and the people that are left are stronger players. So I don't think we'll quite see the 50 or 60% peel back. What will get the stock market going again is the market looking ahead 1 year, 2 years, starting from 2021 and seeing an eventual rebound and responding to that, particularly if there can be some creative spending out of Washington to support the economy.
So we've only got a few minutes left, so let me read off both questions. You got two calls left, and then you'll deal with the time. Steve Dodell from New York asked, you seem to totally ignore gold as a currency, and as the Fed prints trillions of dollars with nothing to back it, gold will benefit from this, plus negative real rates. Elizabeth Prickett asks, what are your thoughts on the potential impact to the economy and markets of effective vaccines and or cures?
Okay, so gold, here's a funny statistic. If you took all of the gold that was mined from the beginning of history, 5,000 years, and put it into a cube, the cube would be about 100 yards by 100 yards by 100 yards. That's it. That's all the gold there is. So trying to run a modern economy of $15 trillion, which is the current economy of the United States, through a gold standard is just not feasible. It's like trying to squeeze a water balloon through a needle. You just can't do it. Mostly it's an emotional component. People cling to it because it's tangible. They can hold it. They can put it in a vault or whatever. But the only value of gold is in the eye of the beholder. And if right now they believe it's worth 2,000, that's the price. And if they change their mind, it's worth 1,000 a month from now, that's the price as well. Nothing to hold it up. For the viruses, yeah, we're super interested in the vaccines. We closed our office March 10th for 6 weeks, for a week initially, and then for 6 weeks. And now we're going to evaluate the decision in December, and we can potentially not reopening our office until all of 2021. We have the good fortune of being a virtual firm. All of my team can work safely from their homes indefinitely. I don't feel like putting my team back into the New York City subway system until I feel like there's a solid vaccine. Now, we know there's 130 companies working on vaccines. We know they're under terrible time pressure. They're creating vaccines in a time frame never seen before. Now, who goes first? You like to think that the vaccine is safe, but some vaccines have health effects, and it's not autism that people are always crying about. It's the vaccine makes you sick, and you can get sick from the vaccine. Even in the best case scenarios, January 2021 is when these vaccines will first be widespread. And then we have to allow for lead time for everybody to get vaccinated. And we also have to take into account the fact that already anti-vaxxers are holding parades about they're not going to get this vaccine, and Bill Gates, get your hands off my body. And I just have to, personally, and as the president of my firm, evaluate the risks until we feel like it's safe.
David, it's 6:29. Any closing comments? You want to put up the thank you screen and your contact information?
So historically, I've had a schedule for talking to all our clients. It's been a little chaotic this year. And if you feel like you're owed a conversation and we haven't had one yet, jump onto our website and heronwealth.com, HERON, wealth.com. And let me just get the screen up. It'll take me a second here. All right, share screen. Yeah, so heronwealth.com. Click on the schedule a discovery session button. That's the exact same button that gets me for phone call. Or if you know my phone number, 917-705-3893. And if you're not a current client and you've got some questions of your own, be happy to talk to you. And Rappy, I think we will wrap it up here for the night. And I wish everybody a pleasant summer afternoon.